Hello, everyone. All right, thank you so much for sparing your time to join my another webinar tonight. And yeah, before I start, I will share a poll here. The poll is about the question be, can you guys hear me? And is it loud and clear? And I will launch the poll right now, and you guys can interact with it. All right, so far yes. Okay, that's great. You guys can hear me well. Okay, that's great. All right, so let's start the webinar now. Okay, so I'm Nicholas and I'll be the MC and speaker for today's webinar. So, as usual, before I start, I would like to show a short disclaimer here. This presentation has not been reviewed by the Securities Commission of Malaysia, and the information provided are only for educational purposes. We do not ask you to buy or sell or invest in any products. However, if you wish to invest, please seek advice from a licensed financial advisor. Okay, a little backstory of Philip Capital. We are incorporated on 7 October 1995. We are a wholly owned subsidiary of Philip Capital Holdings Sdn Bhd. We are formerly known as Philip Futures because back then we only provided derivative products such as futures and contract for difference to our clients. Oops, sorry about that. And until recently we got our stock license, we now also offer stocks. We are a trading participant of Bursa Malaysia Derivative Berhad. We are also a participating organization of Bursa Malaysia Securities Berhad, and we also are holder of Capital Market Services license. Our headquarters is located in Kuala Lumpur, and we have total about 11 investor centers nationwide. So with plenty of investor centers nationwide, you can drop by in any branch if there's any inquiry. Throughout the years, we also won a number of excellence awards from Bursa Malaysia. In recent years, which was the year 2023, we are considered one of the best overall derivative trading participant, and we are also considered one of the best retail derivative trading participant. We have not only offices in Malaysia, but also in 15 other countries, totaling about 16 locations worldwide. In Western countries, we have offices in the US, UK, France, and in Asia, we have offices located in Singapore, Malaysia, of course, Japan, China, and several other countries. So every country that's mentioned here in this slide has an established office. With offices located at different countries means that we have a wide global coverage. What does it mean? We have access to product from exchanges like CME Group, the Chicago Board of Trade, or if you're interested in the Asia market, like the Singapore Exchange, we also do offer their products. If you wish to trade any of the products from these exchanges in this slide, you can do them through us. Why Philip Capital is your one-stop solution for your trading? As a multi-asset broker, we offer a wide range of products, including futures, stocks, and contract for difference. And if you're interested in, let's say, the futures, agriculture futures, you can trade the crude palm oil futures contract with us. Or if you prefer metal trading, such as gold or silver, we also provide metal futures to meet your needs. And for stocks, we offer local shares to foreign shares. Foreign shares including shares from the US, UK, Hong Kong, sorry, not UK, but Hong Kong, Singapore, and Australia. If you are interested in investing in the shares, let's say the US share, you can invest through Philip Capital. For CFD, we offer Bursa, New York Stock Exchange, Nasdaq shares, and also US index, and last but not least, commodities CFD. We are your broker of choice not only because we are an award-winning multi-asset broker, but because of the quality services that we provided to our client, such as 24-hour booking and execution support. We also provide advisory services and update our clients with the latest market news. We also have a wide array of products, as mentioned in the previous slide, and we also offer our own trading platform, which does not require any trading platform fees. You can learn with Philip Capital by having a one-to-one coaching session with us or attend our free seminars or webinars like tonight. For the one-to-one coaching session, We will cover many topics on introduction to futures, CFDs, and stock trading. We will provide you the product knowledge on the product that you are interested in, and we will also coach you on our platform and let you understand our platform charting system. Not only this, we also offer weekly market calls. Our weekly market calls is always hosted on every Monday. However, do take note that for market views and updates hosted by our Philip Securities Research team, we start at 11 a.m. Malaysia time. And for our live counter technical analysis, we start at 8 p.m. Malaysian time, which will be hosted by Zen Au, our technical analyst. All right, this is the QR code for the weekly market calls and upcoming seminars and webinars. The QR code, after you scan it, it will bring you to our website, and from there, you can register to the upcoming events that you are interested in. And this is our online account opening QR. So let's say if you're interested in opening an account with us, you can do so by scanning this QR code or take a picture of it to scan it later to sign up a free account with us after this webinar. Right. Next, I would like to share our trading platform that our client use to trade or invest. We have different trading platform for our different products. Let's start with the first one, Philip Nova. Philip Nova is our trading platform for futures, and you can trade local and foreign futures product through Philip Nova. This platform is equipped with over 90 technical indicators and market depth trading tools for your market analysis. You can scan the QR code here to request a demo account to check it out, and you can install this on your mobile devices as well, so you can trade anywhere and anytime when the market is open. One of the best thing about our Philip Nova is our live chart. It's powered by TradingView. So basically, we get the TradingView charting system and put it on our Philip Nova platform to give you the same trading experience like trading on TradingView. The next trading platform I'll be sharing is Poems Global, which is our stock trading platform, and it's available for installation on your mobile devices as well, allowing you to trade anywhere at your convenience. You can trade local stocks from Bursa Malaysia, or if you're interested in investing in foreign stocks like Tesla, Apple, Nvidia, you can do that as well. Through Poems Global, you can access market in the US, Singapore, Hong Kong, and Australia. Additionally, the platform is equipped with advanced charting indicators and powerful stock analytics to help you better analyze the market and make informed trading decisions. The next platform I'll be sharing is for CFD. It's the Philip CFD Trader. It's a trading platform for our CFD traders. It provides a user-friendly interface with live charting feature, and you can set price alert and use advanced order time in this platform. Coming up next is our promotion. So the first promotion is now we have the 1 ounce gold futures promotion. You can trade COMEX 1 ounce gold futures now till 15th of April 2025 at only USD 0.99. It's your getaway to gold trading with greater flexibility and control. The contract is just 1/10 the size of a micro gold contract. The contract was designed to make gold trading more accessible due to lower margin requirement. You can scan the QR code here to learn more. All right, the next promotion is our Bursa Malaysia Derivative Futures product. From now till 30th of April, you can trade Bursa Malaysia Derivative Future, such as the FTSE Bursa Malaysia Kuala Lumpur Composite Index Futures, also known as the FKLI, or the crude palm oil futures contract, and others that is listed in this slide. You can stand a chance to win an iPhone 16 and up to 350 ringgit cash reward. You can learn more by scanning the QR code here. Our next promotion is the US stock promotion, where you can trade US stock now with low commission rate as low as 0.02% or 1.99 USD. There will be no platform fees, charges, and we will also provide you a free US live data, and this promotion is valid till end of this month. You can scan the QR code here to learn more. And to pair with our US stock promotion, we now also have an amazing giveaway till 31st of March. You can just follow our social media pages such as Facebook, TikTok, Instagram to stand a chance to win Apple product that worth up to 10,000 ringgit. Terms and conditions apply. You can scan the QR code here to start getting some entries. Sorry. Okay, before I start, let me give you a brief introduction about me first. My name is Nicholas, and I'm a dealer and marketing executive at Philip Capital. I graduated from Monash University, Malaysia, where I majored in finance. My interest in the financial market began during the COVID-19, and that's when I started observing how and why the market moved in certain directions. Understanding market trends, price movement, and factors that influencing them really fascinated me, which eventually led me to pursue a career in this field. Okay, let's start with the main topic now. So, what is future? Futures contract are legally binding agreement to buy or sell a specific asset at a predetermined price on a specific future date. Asset could be a commodity, financial instrument, or underlying asset. Futures contracts are standardized. They are standardized in terms of quantity, quality, and settlement terms. Futures contracts are also typically traded. Sorry, I just received a message here that my line is not very good. Can you guys hear me clearly? Hello? Um, okay. Hold on, let me check my Wi-Fi first. Give me a moment. Okay, sorry, I just switched to my data, so I hope it's not that laggy right now. All right, let me start from the beginning again. So sorry. All right, so what are futures? Let's start again. Futures contract are legally binding agreements to buy or sell a specific asset, which could be commodity, financial instrument, other at on a specific future state. And futures contracts are standardized in terms of quantity, quality, and settlement terms. Futures contracts are also typically traded on regulated exchanges such as the Singapore Exchange, the SGX, and the Chicago Exchange. Okay, so there are two types of settlement method at the end of the futures contract period. Hold on, my wife, I think my data also quite laggy. Hold on, let me switch. For a moment. Okay. So sorry, guys. I think the line is back. So sorry. Oh my God. What's happening with the line these days? Okay, I think let me start from the beginning again. I'm so sorry. So sorry everyone for keeping you guys waiting. All right, let's start from the beginning again. All right. So what are futures? Okay, as I mentioned earlier, very earlier onwards, just now, futures contract are legally binding agreement to buy or sell a specific asset, which could be a commodity, financial instrument, or underlying asset, at a predetermined price on a specific future date. These contracts are standardized in terms of quantity, quality, and settlement terms. Futures contracts are also typically traded on regulated exchanges such as Bursa Malaysia Derivative, the Singapore Exchange, and the Chicago Mercantile. All right, I'll speed through a bit in the beginning here until I come this slide here. All right. So there are two types of settlement method at the end of a futures contract period. The first one is cash settlement, and the other is physical delivery. And let me explain each in more details. So for cash settlement, it means that the contract is settled through a monetary payment rather than the actual delivery of the underlying asset. In this case, the holder of the position is either debited or credited the difference between their entry price and the final settlement price. For physical delivery, on the other hand, it requires the actual transfer of the underlying commodities or asset when the contract expired. So in this scenario, the seller, the short position, is obligated to deliver the asset, while the buyer, the long position, must accept and take ownership of it during the contract expired. And this method is more common in contracts for physical commodities such as crude oil, agricultural products, and metals. As I mentioned earlier, futures contracts are standardized. And what does it mean by is standardized? It means that these contracts follows a predefined terms established by the exchange on which they are traded in. And this standardization, it ensures consistency and liquidity in the market, making it easier for buyers and sellers to trade without negotiating individual contract terms. Futures contracts are standardized in terms of the underlying instrument, the minimum price fluctuation, the contract size, the contract months, the settlement method, as I mentioned earlier, is either cash or physical delivery. The next term is value per tick, and last but not least, the final trading day. In other words, the expiration. And now let's look at some common traded futures contract from Bursa Malaysia, starting with the first one, which is the crude palm oil futures contract, known as SCPO. This contract is denominated in Malaysian ringgit and is actively traded on Bursa Malaysia Derivative. Bursa Malaysia Derivative became the world's first exchange to mandate sustainability, requiring all physical delivered crude palm oil futures contract to be MSPO certified. Additionally, the crude palm oil futures contract is Sharia compliant, making it accessible to a broader range of market participants. And the contract is widely used by palm oil producers, refiners, traders, and manufacturers, as well as some fund manager and financial institution, because it serves an effective management tool, enabling participants to lock in prices and mitigate market risk. Now let's look at the crude palm oil futures contract specification. The underlying asset for this contract is the crude palm oil, and the size of the contract is 25 metric ton per contract. The minimum price fluctuation here, also known as the tick size, is 1 ringgit per metric ton, which means that the value of each tick movement is 25 ringgit per contract. The crude palm oil futures contract only allows for physical delivery as a settlement method, which means that at the end of the contract period, the seller have to deliver the asset and the buyer must take ownership of it. But don't worry, while you're trading this, if you trade this futures contract, to prevent the physical delivery, you just have to close out your position before the first notice date of the futures contract. And most of the time, you'll be reminded by your dealer. To close your position, if you had a long position, you just have to short the same contract. Vice versa for a short position. There are 3 trading sessions for crude palm oil futures contract. The morning session starts at 10:30 a.m. to 12:30 p.m. and the afternoon session starts at 2:30 p.m. to 6 p.m. The after hour session, which is also the night session, starts at 9 p.m. to 11:30 p.m. And to enter a position here, a trader are required to place an initial margin of 8,500 ringgit. The initial margin here means that the minimum amount of fund that a trader must deposit to open a futures position. Alright, now let's look at the next commonly traded futures contract from Bursa Malaysia, also known as the FKLI, Kuala Lumpur Index. The FKLI is known as the FTSE Bursa Malaysia Kuala Lumpur Composite Index, which represents the top 30 companies by market capitalization on the Bursa Malaysia main market. You can see the list here. Here are the some of the top 30 companies in Malaysia. There's MIC Berhad, Hong Leong Bank, Maybank, and many other more companies. And here is the contract specification. The underlying instrument of the contract is the FTSE Bursa Malaysia Kuala Lumpur Composite Index, and each contract represents the index price multiplied by 50 ringgit. The minimum price fluctuation is 25 ringgit per half index point, which means that the value for one tick movement is 50 ringgit per contract. The FKRI contract only allows for cash settlement method, and it's same as the crude palm oil futures. It has 3 trading sessions. The morning session, which starts a bit earlier at 8:45 a.m. to 12:45 p.m. and the afternoon session starts at 2:30 p.m. to 5:15 p.m. and the afternoon hour session it starts from 9 p.m. to 2:30 a.m. And to enter a futures position, traders are required to place an initial margin of 4,000 ringgit. Coming to the next topic, why do people trade futures? Or why should you trade futures? So sorry about it, just now my grandmother was here. Alright, so why do people trade futures, or why should you trade futures? So first of all, because of the leverage features and high liquidity. By trading futures, you can take advantage of bi-directional trading, allowing you to profit from rising trends and falling markets. Additionally, futures trading offer a lower transaction cost compared to other financial instruments like the stock market. Last but not least, futures contracts are traded on regulated market, ensuring transparency and securities for all participants. And I'll give more details on each of the reasons. Let's start with the leverage first. So what exactly is leverage? Leverage refers to the ability to control a larger contract value with a relatively small upfront capital. In futures trading, traders are only required to place a fraction of the total contract, typically around 5% to 20% as margin. This allowed this allowed traders to gain greater market exposure without needing to commit the full contract amount. Because of leverage, even a small price movement in the market can translate into a significant impact on your portfolio. And later I'll show you some examples on it. So here's a little example here. If you were to trade the spot crude palm oil contract at the spot market for crude palm oil, let's say it's trading at 4,000 ringgit per ton. The full contract value is 4,000 ringgit times 25 metric ton, which is around 100k ringgit, which is quite a large amount of money. But if you trade using the futures market, and you only require to place an initial margin of 8,500 ringgit. Okay, now I'll be sharing the leverage example. How can leverage impact your profit? if you in trading futures. So let's say you take a long position here in the crude palm oil futures contract, let's say at the 4,000 level. If the market rises by 100 points to 4,100 and you decide to sell at that price, you will have gained 100 points. And since each point is worth 25 ringgit, your total profit, if you do the maths, will be around 2,500 ringgit. Now, let's compare this trading without leverage. If you had 100k and you bought the spot market of crude palm oil, and let's say you have a profit of 2,005 as well, your return on investment is only 2.5%. However, if you trade using futures, where you only needed to place an initial margin of 8,500 ringgit, your return on investment will be significantly higher at 29.41%. This example highlights that how leverage allows traders to maximize their potential return with a smaller upfront investment. However, it's important to note that leverage works in both ways, meaning that losers can be also magnified if the market moves against your position. And I'll show you the next example on how leverage can impact your profit if the market is against you. So let's say you long at the same price, you long at the same level, which is the 4,000 level. If the market goes down by 60 points to 3,940, and you decide to cut loss at this time, and you sell at that price, you would have a loss of 60 points, and it's about around 1,500 ringgit loss. Let's compare this trading without leverage. Let's say you bought the spot market of crude palm oil. A loss of 1,500 ringgit will result a return on investment of negative 1.5%. However, if you trade using futures, the same amount, 1,500 loss, would result a much larger negative return of investment, which is negative 17.65%. As you can see here, leverage is a double-edged sword. While it allows you to amplify your gains with a small upfront capital, it also magnifies losers if the market moves against you. Alright, another reason why traders choose to trade futures is high liquidity. However, it's important to note that not all futures contracts have high liquidity or trading volume. To ensure smoother transaction, it's best to focus on active month futures product. As you can see here, for the crude palm oil futures contract, the active month, the volume is much more than the other months, the other contract months. Same goes as the FKLI futures contract. The volume here, the active month is more than the other months. High liquidity means here is a large trading volume, which makes it easier for trader to enter and exit the market quickly. Futures contract with high liquidity also tends to have a tighter bid-ask spread, reducing transaction costs for traders. And the bid here is the price that the buyers are willing to buy, whereas the ask here is the price that the seller are willing to sell. Additionally, traders can take advantage of bi-directional trading in the futures market. This means that traders can have the flexibility to go long if they anticipate the market prices will rise, allowing them to profit from an upward trend. At the same time, traders can also go short if they believe that the market is going down. They can profit from the falling prices. And this ability to trade in both directions makes futures an attractive instrument as it provides opportunity to benefit from various market conditions. Moving on next to the next reason why traders choose futures. One key advantage is that futures contracts have lower transaction costs compared to stock market. The commission for futures contract is typically a fixed fee per lot per site rather than a percentage of the contract value. And let's look at the example below, the table here. As you can see here, as you can see under the transaction cost for futures here, there will be commission fees and clearing fees to be paid, and the total cost will be around 30 ringgit if you enter the FKI futures. Compare with, let's say you bought the Kuala Lumpur index, which is worth 80K of stocks, you need to pay the commission fees, stamp duty, and clearing fees, which could amount to approximately 0.01% to 0.03%, resulting a cost approximately around 368 ringgit, significantly higher than the 30 ringgit cost in the futures trading. As you can see here, the lower transaction cost in futures trading make it a much more cost-effective option for traders, especially those who engage in frequent buying and selling. Last but not least, the futures contract market in Malaysia is regulated by the Securities Commission of Malaysia. For example, Phillip Capital is regulated by the Securities Commission of Malaysia, where the regulator ensures fairness and transparency in trading. Trading with a regulated broker, it provides investor protection, proper risk management, and compliance with financial regulation. It is strongly discouraged to trade futures with unregulated brokers, as they may have lack of investor safeguard, proper oversight, and fair trading practices, which could increase the risk of fraud or unfair trading conditions. Let's go to the next topic, which is CFD, also known as contract for difference. What are CFDs? CFD is an agreement between two parties to exchange the difference in the price of an underlying asset between the time the contract is open and when it is closed. CFD investor can speculate on price movement without actually owning the underlying asset. Instead of taking physical ownership, they earn or lose money based on price fluctuation of the asset. And similar to futures trading, there's also an initial margin requirement, but they are different depending on the asset classes. You can see the box here. For stocks, the initial margin varies a minimum of 10% for index share and 20% for non-index share, whether they are local or foreign stocks. For commodities, traders are required to maintain a minimum margin of 20%. And for world indices, CFD traders have to maintain a margin of minimum 5%. So why do people trade CFD? People trade CFD primarily because of their key advantages such as leverage and bidirectional trading for same as futures contract. It's just that for futures contract, for CFD, there's no expiry date and you can benefit from corporate action. Here's the comparison between CFD and futures. So both derivatives have the leverage feature, which could amplify gain or losses, and bidirectional trading it can be done for both derivatives. However, for CFD, it doesn't have an expiration date, unlike futures contract have different contract month. Additionally, CFD trader can benefit from corporate action, and I'll explain both in more details later. Last but not least, CFD have a long or short financial charges, but no for futures. These charges only applicable if you hold the CFD contract overnight. It's like swap charges, where an interest is charged daily on orders that's left open overnight until the order is eventually closed. Okay, so I mentioned that CFD doesn't have an expiry date. As I mentioned earlier, compared to futures contract, CFD are open-ended contract and will remain active until the trader decides to close the position, or it may close by broker due to insufficient equity in the trader's account. Earlier, I also mentioned that those who trade CFD can benefit from corporate action. This only applies to stock CFD. Your account will be adjusted to reflect cash dividend, which may be credited or debited based on underlying stock dividend payout. It provides a similar experience like owning physical stock, just that CFD holders are not entitled to any voting rights. The CFD environment in Malaysia is also different from futures. The CFD offered in Malaysia are only allowed based on stocks, indices, and commodities that meet certain criteria by the Securities Commission of Malaysia. CFD may only be offered to sophisticated investors, such as accredited investor, high net worth entity, and high net worth individual. And to know more, you can check under the guidelines on categories or sophisticated investor to know more. Or you can find this information in our Philly Capital website. Or you can also PM me after this webinar. All right, let's move on to the next topic, which is technical analysis. Today, I'll be covering candlestick and how to identify market trend using market structure and using a candlestick chart. You can see here, this is a candlestick chart. It represents the price movement of a security over time. Traders use candlestick chart to analyze and predict futures price movement, whether or not price is going up now or price is going down later. The chart is made up of individual candles, each representing a specific time period. And there are two types of candles in the candlestick chart, if you have noticed earlier. The green candle, which represents the bullish candle, and the red candle, which represents the bearish candle. And now let's understand the structure of both of these candles. How is it formed? Starting with the bullish candle first. When a bullish candle is formed, it created the high and the low for that period. And the opening price is at the bottom of the body here, which indicates that where price has just started, whereas the close is above the body here, which marks that where price have ended. And the area between the open and the close is the body of the candle. And the top wick of the bullish candle is the range from the open to the low. From the close to the high. And then for the low wick is from the range from the open to the low. Next is the bearish candle structure. It's similar to the bullish candle. It has a high and a low. It's just that the open is at the top of the body, whereas the close is at the bottom of the body. Between the open and the close of the candle is the body of the candle. And its top wick is the range from the candle open to the high of the candle. And its lower wick is the range from the candle close of the candle close to the low of the candle. Let us now look at the strength of the candle. The strength of the candle can be told by looking at the size of the candle's body. And we will go through the strength of the bullish candle first, from strong to weak. Okay, let's look at the first bullish candle. We can see that this bullish candle had a large body with short lower wick. It tells us that buying pressure is strong and buyers are fully in control in the market. And coming to the next candle, which is second candle, the second candle starts to have a short lower wick and top wick, and the body shrink a little. It's still considered that buyers are still dominant, but sellers are starting to emerge. As we continue, we can see that the body of the candle had become smaller, indicating that buying pressure is weakening and sellers are beginning to push the price down. Lastly, the final candle, which has the smallest size of the smallest body overall, with a longer top wick. This suggests that buying pressure had dropped a lot and the market may be losing bullish momentum. The long length of the wick tells that sellers have stepped in and pushed the price down, potentially signaling a shift in market sentiment to selling. All right. Next, let's identify the strength of a bearish candle. And here is the first one. We can see that this candle, the first one, the body is large, indicating that the seller is fully in control of the market. And the second candle, the body has shrunk a little, and now it has short wicks. This suggests that sellers are still dominant, but some buyers are starting to come in the market. And continuing the next candle, the lower wick had become longer and the body had shrunk even more, indicating that selling pressure is weakening. And lastly, the last candle, the size of this candle body has shrunk significantly with a long lower wick. indicating that more buyers have stepped in and potentially signaling a shift in market sentiment from selling to buying. So now we have understand a brief fundamental of candlestick. So let us now look at how to identify trend using market structure using a candlestick chart, which is our next topic. So what is market structure first? Market structure refers to the overall framework of price movement, trends, and key levels. By using market structure, we can understand how the market is behaving. And by understanding how the market is behaving, we can make informed trading decision. It, it helps trader and investor to identify patterns, trends, and potential buying or selling opportunities. And there are three types of market structure: the bullish market structure, the bearish, and consolidation. Let us start with the bullish trend market structure first. A bullish market structure, also known as a structure where price is going up, and usually you can find this structure in an uptrend. It can be identified when price is making a series of higher highs and higher lows. And when price takes, or in other words, breaks a recent high and form another new high, we call that action as bullish breakout structure. And let's look at some examples. Let's say we have a high here. The high here, I mark it as HH first, also known as the high. And we can see that price has break through it. This action is called a bullish breakoff structure, and we can mark this action as BOS. And when after this bullish breakoff structure, a new high will be formed, and that it will be the higher high. We can mark it as H. And the new low will also be formed. We can mark it as higher low. And when price continue to break that recent form high again, we can mark the BOS because it's a bullish breakout structure. And you can mark the HH and HL again, the higher high and higher low again, when it is formed. As long as price keep breaking recent high, it will consider as a bullish market structure, and it's more favorable to take long position in a bullish market structure. And let's look at the chart example now. Let's say the recent high is here. Let's mark it as HH, the one circled in red here. For a bullish market structure, we want to see price break above the recent high, which is the one that's circled in red. In this scenario, price had break above it, and we can mark this action as BOS because it's a bullish breakout structure. And when this occur, the new high and new low will form again, and we can mark the new high as higher high and the new form low as higher low. To identify whether the high is valid, we have to see at least a bearish candle close, something like this, the one circled in red. Once you saw something like that, means that the new high is valid. And to see whether the market will continue to go up, we now have to see whether price breaks the recent form highs. And of course, in this scenario, price had break through the recent high. We can mark this as BOS, the bullish breakout structure. And we can mark the new form highs and the new form lows. So just now I mentioned that it's more favorable to go long in a bullish market structure. But how? But first, let us recap again what is a bullish market structure. A bullish market structure, we want to see it forms a series of higher high, HH, and higher lows, HL, where price must break recent highs and not low. And what is the strategy here that we can use to buy in bullish market structure? And I'm going to combine the bullish market structure with support and resistance. This is the strategy. So let's understand the rule first. Rule number 1, we have to look for a break of structure. Second, we have to wait price to rebound from support. And the last one is the confirmation, whether or not price will continue to go up. We'll need to wait to see a bullish close above the bullish close above the support. Let's look at the chart example now. So this is the same chart that I used for our bullish market structure just now. I just zoom out so that we can see the overall picture. And the breakout structure just now is here, the HH and HL. Here, the bullish breakout structure is here. And this line, the bullish breakout structure line, it was previously a resistance. But now it has turned into a support, because when price break resistance and trade above it, the resistance will turn into support. And we can take along or buy when price comes down to support. But we will need to wait for a bullish candle close, something like this here, the one circle in green. And you will ask me, where can you put your stop loss and take profit? So let's say you enter at here, the entry is here. You can place your stop loss here, below here, and your take profit at the previous form highs. Or you can use a 1 to 2 risk reward ratio to take profit and of course for your stop loss. Okay, moving on to the bearish market structure strategy example next. So let us recap first. Oh, sorry, it's not strategy, sorry. Moving on to the bearish market structure first. So a bullish market structure is known as a structure where price is going down and can be found in the downtrend. It can be identified when price is making a series of lower lows and lower highs. And to identify if price will continue to go down, price need to break a recent low and form under the new low. And this action, we can call this a bearish or breakout structure. Now let's look at the example now. The bearish breakout structure example. Let's say the low is here. We can mark it as LL. And if price breaks below it, is a bearish breakout structure. We can mark the BOS. And the new low and new line will be formed again. Which is we can mark it as lower low and lower high. And as long as price keep breaking new low, we can mark that action as BOS and the new low and new high as LH and LL, where LH stands for lower high and LL stands for lower low. And let's look at the chart example. Let's say the most recent low is here, the one circled in red. Let's mark it as the lower low first. So for a bearish market structure, we want to see price breaks below this recent low. And in this scenario, of course, price had broke through the recent low here. We can mark this action as BOS because it's a bearish breakout structure. And we can mark the new form low as LL and the high again as LH, lower high. To identify the low, we will need to see a bullish candle close, something like this, the red candle. Means that the new low is valid. And now to see whether price will continue lower, we want to see price breaks below this new lower low. And price did break through this lower low again. We can mark this action as breakout structure, and as well as mark the new high and the new lower low. And now is the strategy. Let's look at the bearish market structure strategy. So like the bullish market structure, let's do a little recap. For a bearish market structure, we want to see a market form a series of lower lows and lower high, where price must break recent lows and not highs. That's where we can look for sell opportunities. And of course, there's also the selling rules. First of all, we must look at we must look for a break of structure, and we must wait for price retrace from resistance level, and we only can enter when there's a confirmation where there's a strong bearish or a bearish close below resistance. And now let's look at the chart example now. Using the same chart example from the bearish market structure, I just zoom it out as well. So let's say the break structure is here, and this line, it was previously a support, and because price had broke through it, it turned into a resistance. We can take a short or sell when price comes back to resistance, something like this. And we will just have to wait for a bearish candle close. And let's say, of course, here there's the bearish candle close at resistance, below the resistance. Let's say the entry is here. How can we place our stop loss and take profit? Our stop loss we can place, I'll take profit first. Our take profit we can place at the previous low, and our stop loss we can place at the high here. It's not a high, but because there's a green candle close, I'll take that as a stop loss, because the lower high, that stop loss, that risk is a lot, and in trading we will try not to risk a lot. Okay, now I'll be explaining market structure shift. Market structure shift means that the market is transitioning from an uptrend to a downtrend, or from a downtrend to an uptrend. It signals us a potential reversal and change in trend direction. And a bullish market structure shift happens when price fails to create new lows but breaks recent highs, doing a downtrend. Whereas opposite for a bearish market structure shift, where price fail to create new highs but start breaking recent lows, doing an uptrend. And let's direct jump to a chart example. Starting with the bullish market structure shift, we can see now that price is in a downtrend here, and the recent high and lows is here. We are marked as lower high and lower low. For a bullish market structure shift, we only expect that when we saw price fail to create new lows but break recent high here, this high, the one circle in red. And if you see this action, we can mark it as market structure shift. And let's see whether or not this is a market structure shift. So of course, in this scenario, price did fail to create new lows and break the high here, the lower high. And this action is called a bullish market structure shift, and we can mark it as MSS. And now the lower low, previously is a downtrend, the lower low, because it's a market structure shift, it's now in a bullish trend. The lower low now will become the higher low, and then the new high, which is the higher high, will be formed, which is here. Since price had the bullish market structure shift, we will expect price to go higher from now onwards. Now let's look at the bearish example. A bearish market structure shift example. We can see that price is in an uptrend because it keeps breaking recent high and creating new higher highs and higher low. We can only expect to see a bearish market structure shift if price fails to create new high and breaks below the higher low here. And in this example, price had failed to create new higher highs and break below the recent higher low, which indicates that's a bearish market structure shift, and we can mark this as a MSS. The higher high previously was an uptrend, the high high will now turn into a lower high, and the lower low will be formed here. Since price had a bearish market structure shift, we will expect price to drop lower from here onwards. Okay, coming to our last topic for today, let's talk a bit about risk management in derivative. So trading and investing isn't always about strategies. And risk management plays a very crucial role in your trading journey. And to be successful in trading, we cannot just throw risk management aside. Risk management involves in identifying, assessing, and mitigating potential losses. By implementing effective risk management strategies, we can protect our capital and optimize our trading performance. But first, we have to understand the risk management fundamental. We can do it by recognize potential risks, such as stay informed about market condition and economic factors. We can assess the likelihood and impact of risk, as well as use quantitative and qualitative analysis tools. Last but not least, we can develop a strategy to mitigate risks that involve protective measures and contingency plans. There are several risk exposure in derivative trading that you need to take note. The first one already popped up, which is the leverage risk. I had mentioned earlier, leverage feature is a double-edged sword, and without proper risk management, we can amplify our losses if the market goes against us. And the next risk exposure is currency risk. Currency risk can be referred to the potential profit or loss in the foreign currency transaction due to fluctuation in exchange rate. It arises when a contract is denominated in one currency, but conversion to another currency is required. And the next risk is market risk. Traders must also be mindful of market risk, as rapid fluctuation in the underlying market can negatively impact the value of derivative. The price or value of the underlying asset can be influenced by various factors, including interest rate, supply and demand, action by the government, whether is it fiscal policy or monetary policy, and suspension of underlying instrument from trading, and other factors that could influence the price. The next risk I'll be sharing is party risk, because contract for derivative are over-the-counter leverage product traded off exchange. Over-the-counter transactions are less regulated and follow a separated regulatory framework. When trading CFD, trader can only rely on the creditworthiness of the counterparty, which is the broker, and the risk only occurs when the CFD provider fails to fulfill a payment obligation. Next is liquidity risk. CFD have a high liquidity risk. Because CFD does not have a secondary market due to it's an over-the-counter derivative, they are subject to the availability of buy and sell prices and volume. Let us now look at the risk analysis process and what can we do before trading. So first, we must have a plan and development. You must create a comprehensive trading plan which include entry and exit strategies, position sizing, and risk tolerance level, the stop loss. Secondly, you must be disciplined. You must adhere strictly to your predetermined plan and try to avoid emotional trading or emotional decision making during market fluctuation. And lastly, it's advisable to review your trade to keep track on your performance to look for area for improvement and strategies refinement. So you must do your journaling. All right, let's talk about market dynamic risk and assessment. So before you trade, you can first do a pre-trade analysis where you conduct a thorough market research. You can look at what's the trend of the overall market now. You can look at what the economic factors are coming out and so on. So after you do your analysis and you place a trade, after placing a trade, you must monitor your position and be prepared to adjust strategies based on market movement. And lastly, you must regularly reevaluate your risk exposure because the market won't be the same as yesterday. So try to learn how to adapt to any market condition. In conclusion, to embrace risk management in trading, We must always continue to learn by staying updated on market trend and latest risk management technique. You can attend workshop and study other trader strategies on online or YouTube, which may help you in your trading journey. But keep in mind that consistency is the key. You must always apply your strategies and risk management principles consistently. Try to avoid deviating from your plan. And lastly, we must always adapt and evolve. As I said earlier, market will be different every day. So before I end this presentation, is there any question? You can type your questions in the chat box and I will answer it. I'll give a 1 minute time. Okay, is there any question you guys like to ask? Don't be shy, just you can ask any question and I'll try my best to give you the answer that that you want. Okay, if there is no question, or if you have question, oh wait, I saw a question. Well, I speak too soon. Okay, can have webinar live trading when to buy and sell. Webinar live trading. Okay, this one I'll get back to you when I got the answer. If we can do live trading, when to buy or sell. Okay, but for now, I think yeah. Let me let me get back to you after this webinar. Do you guys have any question regarding the technical analysis? The technical analysis part, the market structure. You guys have does market structure works on 15-minute chart? Actually, market structure works in any time frame, but I would prefer to see a higher time frame. So for me, I would prefer to look at the 1 hour chart, 4 hours, and the daily chart. Because I think 15-minute chart for me is too much noises, too much thing happen because you easily see a market structure shift. Let's say within an hour or later, 2 hours later, you see a market structure shift again. The trend will change. Yeah, so yes, to answer your question, it works on 15-minute chart, but you have to, of course, you have to be aware of the market behavior. So let's say if the market suddenly change in direction, you have to know when to exit or when to cut loss. Yeah, but I still prefer to use a higher time frame market structure, which is the 1 hour, 4 hours, and daily. Okay, okay. Is there any more question? Yeah, sorry, I took a long time just now because of technical issues. My line was bad just now. So sorry about that. All right, let's hope I can fix my line issue soon. Okay, if there's no question now. So yeah, let me continue a second. So yeah, this is our online account opening QR for those who missed just now. So feel free to take a picture of it or scan it later to open an account with us. It's free of charge. And of course, if you haven't followed our social media, you can do so. Oh, sorry, I may have skipped too fast. Okay, you can take a picture first. Let me pause for about 5 seconds. Okay, as I was saying, so if you haven't followed our social media, please do so you can keep updated on our company's event and news. You can follow us on Facebook, TikTok, or join our Telegram channel, or follow our LinkedIn as well as TikTok. You can, yes, you also can subscribe to our YouTube channel. And yeah, or if you want to do the old school way, which is Google us, philip.com.my, you can do that as well. Here is our Telegram channel. You can scan this to join them. It's for free. So there are two Telegram channel here, Philip Capital Stock and Philip Capital Futures and CFD. So you scan the QR code to join our Telegram for free here. And for Philip Capital Stocks, we will share updates and recaps on latest market movement, as well as news release for companies in focus. And for Philip Capital Futures and CFD, we will show market views for major indices, uh, commodities and currencies. And of course, we also share the latest update market fundamentals. Okay, and yeah, this is our coaching branch contact. So feel free to drop an email or call us if you have any inquiries, or let's say just now about regarding the webinar, you have any question, you can drop us an email. Oh, wait, is it skip the next slide? But yeah, you can email us or you can drop a call us, or if you want to drop down to our branch, here's the address. And yeah, thank you so much again for joining my webinar. And I would like to apologize just now for the technical issues, and I have to solve it quickly. Yeah, thank you so much everyone for joining my webinar tonight, and I'll see you guys in the next one. And take care. All right, happy weekend. All right, bye bye.